Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 4. This is Section E4. This is a remembering and understanding topic. Identify the factors an auditor should consider when reporting on supplementary information included in or accompanying an entity's financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to superfastcpa.com and sign up for our free 1-hour webinar training. Again, it is free. It is only 1 hour long, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. After you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Pro members get access to the full 10-question versions of these 5-question YouTube videos. So in today's video, we're only going over 5 questions, but Superfast CPA Pro members will have access to the full 10-question version of the video so that they can get a little bit more help and a little bit more understanding. So if you like this and you like other stuff, become a Pro member. Now with that, let's dive into the questions. All right, here we are at question 1, and something I always like to point out if it's an option is you want to read the last sentence or the last part of the question first, because that will give you context for what the question is talking about. Now, of course, you can't use it in every single situation because sometimes there's only 1, maybe 2 sentences, but it's still a very good habit to be in because, again, it gives you that context for what you're dealing with. So let's do that with this one to get in the habit. Which of the following best describes the auditor's responsibility for this information? Okay, let's go up to the top. A CPA is performing a financial statement audit for a non-issuer and encounters supplementary information labeled as required by FASB. Which of the following best describes the auditor's responsibility for this information? Okay, so let's go through this. Option A, the auditor must perform audit procedures and express an opinion on the information. Option B, the auditor should perform limited procedures and include a separate section in the report. Option C, the auditor should apply PCAOB standards and include an explanatory paragraph in the report. Or option D, the auditor is not required to read or consider the information since it is outside the basic financial statements. So what do they have to do with this supplementary information that's required by the FASB? What's their responsibility? If you have no idea, that's okay. We are going to use these questions to learn this. So let's dive into the explanation together. All right, here we are. The answer is B. The auditor should perform limited procedures and include a separate section in the report. Okay, so we're going to learn something important about supplementary information in this question. Let's go over it. When supplementary information is required by FASB, it is considered required supplementary information or RSI under GAAP. For RSI, or again, required supplementary information, the auditor must perform limited procedures such as inquiry and comparison to the audited financial statements and must include a separate section in the report titled Required Supplementary Information. The auditor does not express an opinion on RSI. This is different from other supplementary information, which is OSI, which is not required by GAAP. For OSI, the auditor may be engaged to perform audit procedures and express an opinion that it is fairly stated in relation to the financial statements. So there are kind of 2 situations. There's required supplementary information, and the auditor's only going to do limited procedures just to make sure that they're only going to do limited procedures on that and they're not going to express an opinion. But other supplementary information that's not required, they may be engaged to audit it and express an opinion on it and things like that. So I wanted to make sure that that was clear, the distinction between the 2. Option A is incorrect because full audit procedures and an opinion apply only to OSI, not RSI. C is incorrect because PCAOB standards apply to issuers. And D is incorrect because the auditor must still read RSI to determine if it's consistent with the financial statements. So auditors can't just not read the information, even if they are not going to give an opinion on it or anything like that. They still have to read it to see if it's consistent. And we did notice there that because this was a non-issuer, they are not going to be under the PCAOB standards. So that's something that we're going to kind of see again in the next few questions. So just wanted to make sure that it was clear the difference between RSI and OSI. Now let's go to the next question. All right, here we are at question 2. This is just one long sentence, so we're going to read the whole thing. When an auditor is reporting on supplementary information accompanying audit financial statements, under what condition can the auditor express an opinion that the information is fairly stated in all material respects in relation to the financial statements? So let's go through the options. Option A, the auditor performed audit procedures on the information in connection with the financial statement audit. Option B, the auditor reviewed the information using standard review procedures. Option C, the auditor evaluated the information based on management's representations alone. And then option D, the auditor is not permitted to express an opinion on supplementary information under any circumstances. So again, which of these conditions are they going to express an opinion whether these are fairly stated in all material respects? So if you have any idea from the first question, that's great. But if not, that's okay. We are using these questions to learn. So let's dive into the explanation together. All right, here we are at the answer A. The auditor performed audit procedures on the information in connection with the financial statement audit. So let's go through this. Auditors may report that supplementary information is fairly stated in all material respects in relation to the financial statements as a whole, but only if the auditor applies sufficient audit procedures to the supplementary information and the audit of the basic financial statements resulted in an unmodified or qualified opinion, not adverse or a disclaimer of opinion. So this is positive assurance. That's the kind of thing that they're doing here. So it's not review level, so that would make B wrong. And it's not based solely on management's word, so that would have made C wrong. If the auditor is not engaged to audit the supplementary information or cannot obtain sufficient evidence, they may disclaim an opinion or omit reporting on it entirely, but they are not prohibited from reporting altogether, which would have made D wrong. So I just want to kind of talk about that last point one more time. If they're not engaged to audit the supplementary information or they can't get sufficient evidence, then they can make a disclaimer of opinion or omit reporting it, basically for the disclaimer saying, hey, we couldn't get enough evidence, so we're not going to give an opinion. But again, they're not prohibited from reporting altogether, so that would have made D wrong. Now, one last thing. However, even if the auditor is not engaged to report on the supplementary information, kind of like we just said, they are still responsible for reading it and considering whether it is consistent with the audited financial statements. So even if they are not engaged to audit the supplementary information, but it's still there with the financial statements, then they have to at least read it and consider whether it's consistent, even if they're not going to give an opinion on it. So we learned a lot more there. Now let's go to the next question. All right, here we are at question 3. How does the presentation of supplementary information in the auditor's report differ from an issuer and a non-issuer when the auditor has audited the information? We talked a little bit about that in question 1, but let's dive in more. Option A, for both issuers and non-issuers, the auditor must include a separate section titled Supplementary Information. Option B, for non-issuers, supplementary information is reported in an explanatory paragraph. For issuers, it appears in a separate section. Option C, for issuers, an explanatory paragraph is used. For non-issuers, a separate section titled Supplementary Information is added to the report. And then finally, option D, both issuers and non-issuers must issue a separate report to cover supplementary information. Okay, so again, what is the answer? If you know, based on anything we've learned so far or something you might have known before, that's great. But if not, maybe pause the video, think through this and try to give a good guess. And when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C. For issuers, an explanatory paragraph is used. For non-issuers, a separate section titled Supplementary Information is added to the report. Now, that is the correct answer right now. From what I understand, that may have changed in real world, but as of right now for the CPA exam, that is the correct answer. Now, in the future, it might change, so, I might update that in the future. I think that now it's just a separate section for both issuers and non-issuers. Just want to make sure that's clear. But for the CPA exam as of May 2025, this is how it is right now. So let's go over it. When supplementary information has been audited and the auditor is reporting on it, the location in the auditor's report depends on whether the entity is an issuer or a non-issuer. For non-issuers, a separate section is added to the auditor's report, typically titled Supplementary Information. For issuers, the information is referenced in an explanatory paragraph, and remember we talked about those a few videos ago, following PCAOB standards. In both cases, if the auditor concludes the information is fairly stated in all material respects in relation to the financial statements, that positive assurance may be included, but the format differs, between issuer and non-issuer. Issuing a separate report is permitted in some cases, but it is not required for either type. So D is incorrect because it's not required, but you can do that in some cases. Again, this is currently what you need to know for the CPA exam. If it changes, then I will, update this in the future. But as of right now, this is what you need to know. So with that, let's go to the next question. All right, here we are at question 4. And again, this is another one of those questions where we can read the last sentence first just to get a little bit of context. How should the auditor report on the supplementary information? Okay, I think you can see why that is helpful. Imagine you were at the exam on test day and you read that last sentence first. You immediately know you're dealing with supplementary information, and that will help you to know what to do as you're reading through the rest of the question. Again, that's why you do it, to get yourself context. Let's go up to the top. An auditor has applied appropriate audit procedures to supplementary information accompanying the financial statements of a non-issuer. However, the auditor issued a disclaimer of opinion on the financial statements due to a pervasive scope limitation. How should the auditor report on the supplementary information? Okay, let's go through this. Option A, issue an unmodified opinion on the supplementary information since it was audited separately. Option B, state that the supplementary information is fairly stated in relation to the financial statements taken as a whole. Option C, express negative assurance based on the limited procedures performed on the supplementary information. Or option D, disclaim an opinion on the supplementary information because a disclaimer was issued on the financial statements. Okay, so what are they going to do in this situation? If you have a good guess, pause the video and think about it. If not, let's go to the answer right now. All right, here we are at the answer D, disclaim an opinion on the supplementary information because a disclaimer was issued on the financial statements. So let's go through that and kind of explain that. To express an opinion on supplementary information, the auditor must have issued an unmodified or qualified opinion on the financial statements. If the financial statement opinion is adverse or a disclaimer, the auditor cannot express an opinion on the supplementary information even if audit procedures were performed on it. So that's why they would also have to give a disclaimer of opinion for the supplementary information, because they can't express an opinion on it because they had an adverse or a disclaimer of opinion for the actual audited financial statements. So they can't give an opinion, so they have to have a disclaimer of opinion. Now, one thing that's kind of unrelated, but I wanted to throw it in one of these questions because this is something that I think you should know. And so this is a little bit unrelated, but it is something you need to know. One additional piece of information. The auditor must use the same materiality level applied in the financial statement audit when evaluating the supplementary information. So I felt like it kind of fit into this question, and it is something that I wanted you to know. So if there's a disclaimer of opinion on the audit, then there's going to be a disclaimer of opinion on the supplementary information because they can't give an opinion on the supplementary information. Similar to that, the same materiality level that was for the audit has to be used for the supplementary information. Now let's talk about the other answers. Option A and B are incorrect because an opinion on supplementary information cannot be given when the financial statement opinion is a disclaimer. And again, you are giving a disclaimer of opinion for the supplementary information, which basically is saying we can't give an opinion. And then option C is incorrect because negative assurance is not appropriate for supplementary information. That applies to review engagements, not audits. And we've talked about review engagements in a couple of videos. With that, let's go to the next question. All right, here we are at question 5. Under PCAOB standards, how should an auditor report on supplementary information for an issuer if they were unable to obtain sufficient appropriate evidence to support an opinion on that information? So we have kind of learned a little bit about this so far, so let's go through the options. Option A, express a qualified opinion on the supplementary information and explain the limitation. Option B, omit any mention of the supplementary information from the auditor's report. Option C, issue a disclaimer of opinion on the supplementary information and explain the reason. Or option D, include a separate section titled Supplementary Information describing the missing audit evidence. So again, what are they going to do here? To be honest, we kind of have already learned about this. So pause the video, think about what we've learned so far, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is C, issue a disclaimer of opinion on the supplementary information and explain the reason. Okay, so we just barely talked about disclaimers of opinion, so it makes sense why this would be the answer. Let's go through this. If the auditor cannot obtain sufficient appropriate audit evidence about supplementary information under PCAOB standards, they must issue a disclaimer of opinion on the supplementary information and include an explanatory paragraph explaining why the disclaimer is given and stating that the auditor does not express an opinion. And again, we kind of already talked about that in question 4. If you can't get enough evidence to give an opinion, then you have to give a disclaimer of opinion. This ensures transparency for users of the financial statement so that they know, hey, we're not giving any opinion on this supplemental information because we didn't have enough evidence. Now let's go through the other options. Option A is incorrect because a qualified opinion is not appropriate when the evidence is insufficient. You would do a disclaimer of opinion. Option B is incorrect because PCAOB standards require the issue to be explicitly addressed. They do require you to explicitly say, we couldn't give an opinion because of this. And then option D applies to non-issuers, not issuers. So supplementary information section title, that is going to be for non-issuers. Again, that's one of those rules that I believe is still current for the CPA exam, but may change in the future. So we'll see how that goes. But overall, we learned a lot in this question and the other 4 questions. Before we do anything else, let's do one more part of the Superfast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the differences for supplementary information for non-issuers or issuers, potentially. Again, these are the things you're noticing throughout the questions, so you take the time to pull out the key points, the pillar topics, based on what you learned, and you write them out in your own words so that as you're doing this each day, you are building your own personal repository of the most important things you learned from the questions so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about engagement type. The auditor's responsibilities for supplementary information are determined by the type of entity, issuer or non-issuer, and the applicable auditing standards, PCAOB or AICPA, not just by who issued the accounting requirement. For example, FASB may issue required disclosures under GAAP, but the auditor follows AICPA standards for non-issuers and PCAOB standards for issuers. So again, for issuers, it's PCAOB standards. For non-issuers, it's AICPA. That's the general thing that you need to know there. Now let's talk about expressing an opinion. An auditor may provide positive assurance that supplementary information is fairly stated in relation to the financial statements if sufficient audit procedures were applied and the financial statements received an unmodified or qualified opinion. It can't be an adverse opinion or a disclaimer of opinion. The auditor must use the same materiality level as in the financial statement audit. And again, that was something I kind of threw into question 4. Now let's talk about the auditor responsibilities. The auditor must read all supplementary information to ensure it is not inconsistent with the audited financial statements, even if not engaged to report on it. If the auditor does report on it, they must explain whether they audited, reviewed, or disclaimed an opinion on the information. Now let's talk about the reporting format. For non-issuers, supplementary information is presented in a separate section of the audit report. For issuers, it is referenced in an explanatory paragraph under PCAOB standards. In either case, the report may also be issued in a separate document if appropriate. And then finally, some limitations on reporting. If the auditor cannot obtain sufficient appropriate audit evidence on supplementary information, they must disclaim an opinion and explain why. This is required under PCAOB standards and applies even if the basic financial statements were audited. Now, with that, we went over the pillar topics and the first 5 questions for this video. And remember, that is it for this YouTube version of the video. We are only doing those 5 questions, but remember, SuperfastCPA Pro members will get access to the full 10-question version of the video, which I'm about to finish after I make this. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member so that you can get access to a lot of great stuff, including, again, the full versions of these videos. And the easiest way to become a pro member, or at least learn more about it, is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training. It's only 1 hour long, and it will teach you the key ingredients to passing the CPA exam, and that will give you a good path to, again, learning about and becoming a SuperfastCPA Pro member. So check out the webinar, check out becoming a pro member. If you liked this and you felt it was helpful, make sure to like it and leave a comment. I hope it was helpful, and I will see you in the next video.